Welcome to LiveWire's Fund and Focus series. I'm Hans Lee, and joining me today is Adam Grotzinger, Senior Fixed Income Portfolio Manager at Neuberger Berman, and we are discussing the Neuberger Berman Strategic Income Fund. Adam, welcome.
Thanks, great to be here.
So Adam, I thought we should just start with this. Why should an Australian investor consider exposure to global fixed income?
Yeah, sure. I think there's a couple things. One is just kind of the interest rate level outside of the Australian market is attractive today. So if you think about kind of yields on offer in the U.S. dollar market, where the Treasury market's yielding today, where corporate credit's yielding kind of in the upper single digits, where things like agency mortgages are yielding kind of in the 5 to 6 handle kind of range. These yields as compared to kind of opportunities in Australia, equivalent to sometimes better depending on kind of the risk profile you're taking. So there's no yield give up in leaving Australia per se. And then also I think it's just kind of a more philosophical question on portfolio construction. The Australian bond market as compared to bond markets outside of Australia, Australia is a small debt capital market in the broader kind of global set of debt opportunities. And, it does have its biases in terms of sectors that issue debt, the banks, maybe some commodity types of exposures. And so, if you want to build more diversification beyond those opportunities, the global debt markets, give you that in addition to the yield proposition.
So I mentioned it there at the top. It's in the name. What makes the Strategic Income Fund strategic and therefore different from the other fixed income funds which are in the market?
Yeah, the naming of the fund, Strategic Income, is really to convey, how we think about the best relative value opportunities in the fixed income market on a recurring basis, 12 months kind of looking forward, and being strategic in our pivoting to those opportunities as the pricing of those for the fundamental or realities of those kind of sectors changes over time and evolving the portfolio, in short, to kind of where the market is presenting us the most attractive, not only return opportunity, but return opportunity per unit of confidence of us actually monetizing that for our clients and then rotating to kind of, the market's new mispricing at that given future point in time. So, a strategic mindset to building, a diversified but, a dynamic asset allocation portfolio that does that for clients.
So I'm curious, Adam, and obviously given your hands-on with the tools and the trades, what does the portfolio look like at the moment, and what do you think it could look like in 12 months' time?
Yeah, it's a great question, and I think it cuts to kind of the heart of how we have evolved. So I'll give you a little bit of historical perspective, and then how we're potentially likely to evolve if certain events and pricing plays out in the market in line with our expectation. First I would just say this is a portfolio that has full discretion on opportunities in the debt markets, full stop, globally, but it's always looking for this North Star, so to speak, of optimizing for the best return while exhibiting an investment-grade risk profile and an investment-grade average credit quality at the portfolio level. So, there are definitive boundaries in which we're kind of trying to optimize that return for. It's not taking high-yield risk or kind of higher beta ends of the debt markets in our risk parameters. The quest we really have today is kind of where's that best value. I'll say a couple years ago, so 2021, we had a very strong conviction view that the best value was in maximum risk in corporate credit, and in particular high yield. We had upwards of 50+% of our portfolio in the high yield corporate markets back in 2021, and we are running with very limited duration before the Fed started raising rates back in 2022. So it was full credit risk, limited duration risk back in 2021. That was the place the markets presented us the best opportunity. If you look at the portfolio today, it's almost the inverse of what it was in 2021. Today, it's not short duration risk, it's actually intermediate duration risk. So we've gone from 2 years to kind of 5 years of duration on purpose. Interest rates are more attractive. and we've lessened our corporate credit exposure in favor of more interest rate sensitive sectors of the bond market. Short-dated or intermediate duration treasuries, in occasion some German bunds in the non-U.S. market, and also agency mortgages. Corporate credit, in contrast, that 50% exposure we had to high yield back in 2021 is today around 15-16% of the portfolio. So a dramatic reduction, in contrast to where we saw the opportunity in 21. And, where are we going to go going forward? Our thesis is right now corporate credit, selective opportunities, but keep exposure, lower than normal, reflecting tighter valuations. Put more of our risk capital in duration-sensitive assets that have cheapened in this environment. And as the Fed and ECB start cutting rates and interest rate volatility normalizes, those interest rate-sensitive instruments we own in the portfolio that don't have credit risk should perform strongly. We'll be able to monetize those gains, and that's what we'd like to do in that environment, and then assess where the market's presenting the next opportunity. Maybe credit widens in terms of credit margin or spread, and we'd have, the liquidity and risk budget to get back aggressively into credit, but be better buyers when it's cheaper in effect.
So passing that all together and talking about the opportunity set, as you've just discussed, tell us about some of the returns that your fund has achieved over the last few years.
Yeah, this is a strategy we've run, outside of the Australian market. In the U.S., we started this back in 2003. So, this is a strategy that we've run really in kind of different domiciles, but in the U.S., the longest track record going back to 2003, that's delivered, over a considerable number of years through the GFC, et cetera, kind of an average annualized return that's kind of been in the mid-fives, at times close to 6%. And that's been a return that, has been commensurate or better than the risk we've taken, volatility of 5-6%. And that volatility has kind of been within the confines of what investment grade debt's giving you from a volatility point of view. So our ongoing quest is maximize return and deliver a return commensurate or hopefully better than the risk you're taking or the NAV fluctuations you're exposing clients to. Over the last couple of years, it's been challenging, right? Because we've been through an environment where interest rates have risen. And when interest rates rise, as they've done aggressively in the last couple of years, that's been bad for a lot of parts of the bond market. So kind of our goal one in that environment is doing the best to protect on the downside versus kind of broad fixed income representations of what you get from performance. And I think, we've done a good job with that. And on a go-forward basis, it's really about, it's hard to project a total return, but if you look at the yield of the portfolio in the sixes, again, that's a good kind of barometer for kind of, the return profile we can, estimate on a kind of go-forward 12-month basis with the opportunities we see in fixed income today.
All right, some great insights there. Adam Grotzinger of Neuberger Berman, thank you for joining us.
Thank you.
And thank you for joining us. If you enjoyed that interview, you can subscribe to the Livewire and Market Index websites, as well as our YouTube channel, where you can find more funds in focus. Thanks for watching.